Hi, my name's Phil Williams. I'm the CEO and chairman of Consolidated Uranium. We're a global uranium developer with a focus on near-term production in the US.
Phil, good to see you. Haven't seen you since September. Little bit crazy markets. We saw some highs and lows and probably lows again. How are you feeling about things over there?
Yeah, look, you're right. It's been a very volatile time. And certainly I thought we'd be in a much better position now than we are. And it's global financial markets as much as it is the uranium market. But we feel very good about our business and what we're doing. We've got exciting projects that we're working today, and we have a very healthy balance sheet to weather any storm.
Right, because when you kind of came, you came running out of the gates, as it were, at high speed. I think the market got a little bit excited about what you were creating there. And then I think as the market kind of picked up, it kind of killed your M&A game. Do current conditions help you in that regard? Because your equities have come way off again.
Yeah, Matt, they certainly do. And our pipeline has always been full. And but certainly companies have been more interested or less interested as the markets have heated up about doing deals with us. And I think now they're realizing that the consolidation strategy, being part of a bigger entity with better access to capital, better trading liquidity, makes a lot of sense. And so those conversations have heated up, particularly of late. So I think there's a real opportunity for us to continue to pursue that strategy and build out our portfolio.
Well, we've seen some big transactions happen recently, and the UEC, UEX deal for one. But those are truly big companies. You're still kind of the 130, 150 million market cap level. I mean, how do you pitch yourself to some of these perhaps slightly tired CEOs, perhaps cash constrained, or quite frankly unsure of how to move forward? What are they buying into?
100%. It's very simple. 1 + 1 can equal more than 2. And we do. That's what we do. We point to the deals that UECs has done. We point to the Encore deal. We point to the Deep Yellow Vimy deal, and we show, consolidation is happening. There are obviously synergies to doing consolidation in terms of reducing your G&A, but more importantly, it's about what's the growth profile of the combined business. How do we get on more radar screens? How do we lower our cost of capital by having access to more bigger institutional investors who want to invest in those bigger companies? And I think together, particularly our business with some of the assets that we're looking at and companies that we're looking at, could be much, much stronger.
So what about your focus? Okay, last time we spoke, I kind of went after you a little bit with regards to your attempt to acquire Queensland assets and Argentinian assets, given the kind of Australian Labor government's attitude and Australian government more broadly attitude to nuclear difficulties in Argentina. But you've done two quite clever things recently. You've kind of spun out Moran Lake to Labrador Uranium, and you've also made another acquisition. What are you working to? I'm not quite sure, what it is that you're trying to be.
Yeah, look, and so when we started the company, we were focused on acquiring these unloved, forgotten assets for pennies on the dollar. And sometimes that took us to those jurisdictions that were a little higher on the risk profile, although those countries we like particularly, but maybe in those sub-jurisdictions, and you point out Queensland, of course. But our goal here is to create a multi-asset production vehicle. Starts in the US, we have past producing mines, we can turn them on very quickly. And now it's about what comes behind that, what jurisdictions do we want to go after, and what projects we want to add there. And you mentioned Argentina, and just an anecdote, we had the PDAC here in Toronto a couple of weeks ago. There were 9 governors of states in Argentina that had come up to the conference, talking to investors, talking to companies, trying to explain why Argentina is a great jurisdiction for mining investment. And we just had a team of 4 guys go down to Argentina looking at other opportunities. I think that's going to be a very important jurisdiction going forward for us. And it's on top of being extremely prospective for uranium and other metals that might come along with those deposits. It's a nuclear country. They're building out their fleet. They're looking for domestic sources of supply. So I think that could be a really big part of our story going forward. Australia maybe a little bit behind that, but I think there's other things to do also in Australia where we could add to our portfolio.
Right, but again, I come back to the question: what are you trying to be? It seems with the deal that you did with Energy Fuels, you want to be a producer, right? And I want to talk about that in some detail because I think that's one of the more important things that you've done since we spoke. Obviously, the spin out of Moran Lake. I'd like to understand why you spun it out and didn't keep it in the portfolio. And yeah, you've got some of these. Okay, I think Australia, Argentina. We can park that up for now, but you kind of got these kind of very early stage exploration components in Canada too. So are you aiming to be a producer developer? Are you aiming to just be just that, consolidate uranium projects and then work out what you do with them at some later date? I mean, what is the vehicle about?
No, so we're now pivoting 100% focused on becoming a producer from our assets in the US. And then it's about, okay, how do we leverage the platform? So we build out this expertise in production. We want to have assets behind that are actually our development assets. And so that's where we're going next. And it's either assets that move up within our existing portfolio or other assets that we bring into the portfolio that will be the second and third projects in that pipeline for development. Okay, well, so let's go.
Let's talk about the deal you did with Energy Fuels. So I know it's so long ago, but I think it was super important. I saw it at the time, and I guess we should have spoken sooner. But you've got perhaps one of the better US former producing projects on your books. You've also got Energy Fuels as a shareholder and the ability to access the White Mesa Mill. Not bad.
Yeah, no, we couldn't be more excited with those assets, and I think this is a great time to be talking about them because. Even when we acquired them, we were still understanding what we had. And over the last 6 months, we've really figured that out. And what we've decided to do as part of understanding that is to go do work on these projects. And we're one of the busier US uranium developers, near-term producers right now, with 3 drill programs going on the 3 past producing mines that we bought from Energy Fuels.
Right. Okay. But this is the bit that interests me. It's the access to the White Mesa Mill. It's the only agreement that they've got with any company in North America to utilize their facilities. Is that right?
No, it absolutely is. We're the only company with guaranteed access to the mill other than Energy Fuels. And if you talk to Mark and you talk to Energy Fuels, they have no plans to give another agreement like this to any of the other companies. So that's a huge strategic advantage for us. And when we look at our peers and you say, okay, maybe you have a past producing mine, maybe you have something that's permitted, but if you can't actually turn the mined ore into yellow cake, then why would you even invest in turning a mine on? You need, and getting access to another mill, either a new mill or even an old mill, is a 5-year plus exercise. So we have this near-term advantage over our peers, and that's going to create a lot of opportunity for us.
But if say your competitors could, other North American hard rock uranium miners could access the mill. I mean, what do those deals look like? If you don't own it, I guess you're tolling it. Is that right? What are the options?
Well, right now there are no options, but you could. I mean, we have a 12 million agreement, which means that we take our ore to the mill, we pay for our share of the processing costs, and we get all the upside when we sell the uranium. We're not sharing any of that with Energy Fuels. I think that if, and I don't want to speak necessarily for Energy Fuels, but I think that they could be looking at ore buying agreements with other parties where basically they just buy the ore and the company might make a small margin, but they don't get the exposure to the uranium price that we get. And, our company's built on leverage to the price of uranium. And I think our investor base is backing us for that reason. And so if uranium prices run like they did in 06, 07, we can get the full exposure to that. I think some of our peers will not be able to get that full exposure if they have to sign deals like the one I just talked about.
Right. Okay. But how do you gear yourself up for this? Okay. So I've got a clear picture now. What you want to be within the context of the total portfolio. But you're going to have to commit to the US. And if you want to be a producer, you're going to have to commit. And that means commit budget, commit people, commit to a plan, start doing all of those things we talk about with the kind of more advanced projects. That's, try to get term contracts in place, try and get, your capital in place. I mean, how are you moving things forward there?
Yeah, look, we're doing all of those things. So the first thing is we're drilling to understand in certain cases, confirming the existing resources, and in other cases, expanding on the existing resources. So we have a very good handle on the Tony M resource. We've just finished a confirmation program. We're going to have an updated 43-101 there. At Daneros and Rim, we're exploration drilling there. Those projects haven't been explored beyond where they stopped mining in a decade. So those programs are going to expand those resources. And then at the same time, we're building our team, we're activating permits, we're going out for contracts for contract miners, and we're getting ready to make a production decision towards the end of the year. The last piece, which you mentioned, is the contracts. And that's the next piece that we have to tackle, and we're working on that. And fortunately, we've got Energy Fuels as a partner. I mean, they're already signing contracts, and there's every opportunity for us to dovetail in behind them if that's the path we choose, or go out and try to sign contracts on our own. And we're starting to do the work to understand what kind of contracts we could be getting. Okay,
so that's the contracts with utilities, and obviously it's a very dynamic and fluid environment. More broadly, with uranium pricing, we've seen, obviously we talked about it last time, Sput obviously doing their thing, and you've kind of got a few European counterparts doing their thing too, and trying to move that, but it's kind of stalled at the moment. In fact, gone backwards slightly. I think we saw early 60s pricing a few months ago, back down sort of low 50s at the moment. So. How do you operate in an environment like that? Because utilities are less than forthcoming. Governments talk a good game, but don't actually kind of give, they don't stump up the money. So you've got to kind of commit in a way. I think last quarterly, you talked about $28 million in places. Let's say, where are you? 25, 26 million now. How do you position yourself in that environment for investors to say, look, do you know what? This strategy makes a whole bunch of sense. It's better that we try to be a producer and get that producer re-rate potentially than kind of continue to build out the portfolio, or can you do both?
I mean, I think we could do both. But one thing I would say is, because these mines were in production in the past, and there's been over $100 million of CapEx spent on them, our incremental CapEx to bring them back in production is very low. We have it on our balance sheet today. So we don't have a financial commitment beyond our balance sheet to turn these mines on. And I think that gives us a lot of flexibility with respect to signing contracts. And when you say that the utilities are kind of slow and stalling, part of that is true. The other part is we have seen US utilities particularly signing contracts with US producers. Because of everything that's happening geopolitically, domestic US utilities know they need and want domestic sources of supply, and they're going to come and get it. I think we're in a unique position because we're fully funded to build out our mines, that we can take a bit of a hardline approach. And again, we're trying to give our investors the direct exposure to the price of uranium. If we have another bull market like we have, we want to be able to be delivering production into that market and not have our sales price capped.
Right, but okay, well, term contracts come in all shapes and colors, right? So it's be down to you to negotiate that by proving, one, we have produced in the past and we can produce in the future. Because obviously the energy fuel guys will be doing that for you, operating it for you. But I'm just specifically interested, you say that utilities are signing contracts. They're not signing it in the numbers that gives the market confidence that the price will keep moving forward. And that's kind of a problem for people like Sput in terms of, being able to access the ATM. The ratio isn't quite right there for them. So it's still a kind of stuttering, spluttering, albeit really positive thesis, but it's not moving at the pace that investors would like. But for you, given you're just starting up, is it you're okay with the pace that this is working out at? You're trying, in terms of positioning yourself and trying to work out what you want to be?
Yeah. Yes. I mean, look, it's not moving as fast as we would have liked it to be. So we do have to exercise some patience. But in the meantime, what we're doing is being ready so that we can make that production decision and go back in production very quickly. And I think, again, to hammer home the points about our company and why we're unique in that we can turn on very quickly, fully permitted, past producing mines. We can turn them on very quickly for a low amount of capital, and we have access to the mill. So we can be very nimble and hit the market when it comes, but we can also be patient and listen, we still need, a few months here to be ready to make that decision. So we do have that patience. The other thing about the nature of our mines is they're very flexible. We can turn them on and off very quickly. We can go in and batch 10, 15, 20,000 tons of ore at Dineros, for example, the last mine that was in production of our projects in 2013. We can go and batch it, take it to the mill, process it. And if the market, there's a lot of volatility in the market. If the market comes off, we can just sit back, and it's not going to cost us a lot of money to turn that mine off and wait for prices to rebound again to turn it back on.
compared to ISR?
Compared to ISR, compared to a lot of other mines that need, any project that needs tens and tens of millions of dollars of capital, you're not going to build it, turn it on, and then turn it off very quickly. You just don't have that capability, particularly if you debt fund it. We have all the cash on our balance sheet, so we can go ahead and do it. But certainly an ISR mine isn't as flexible. Once you turn it on, you have to keep pumping fluids through, even if you're just remediating or trying to remediating that well. You have to do that for years after you start. Okay. And that's a cost. That's a cost that needs to be factored in to your decision matrix around, am I going to turn this mine on or not?
Right. So right now you kind of got the optionality with the speed at which you move the US assets forward. You've got an able and willing partner there, shareholder as well, with regards to the technical aspects of how you move that into production as well. So that's good. I like that. I kind of like that. I like seeing that. I need to talk about Labrador Mining, right? So Moran Lake, you chose to spin this out rather than do this yourself internally as part of Consolidated Uranium. First of all, why the spin out? And then two, what's your kind of relationship with the new company?
Yeah, look, so as we're always looking sort of 2 steps ahead with all the assets. And ultimately, when we entered that camp, this is the Central Mineral Belt. It's a huge belt, very prolific. There's multiple uranium deposits, including Paladin's very, very large Michelin project. We wanted to consolidate the entire camp when we first got in there. We just took a toehold in Moran Lake and a very substantial resource to start with. What we ended up figuring out is that there was a partnership to be had with Altius, who had a big swath of ground in the belt, to create an exploration company and really go after new targets within the district. That wasn't, our strategy at CUR is to become a producer and a developer of resources, not be an exploration company. And we've never picked up a project that didn't already have resources, because that's not our strategy. Exploration is what Labrador Uranium is purposely built to do. They've raised nearly $20 million to do that. They're going to be an aggressive $5, $6, $7 million program this summer. And it's now managed by an entirely separate team. Stephen Keith is the CEO. He's got an unbelievable staff and team of geologists and experts underneath him that are working the project. I'm the chairman of the company, so we still have an involvement. But recall, what we did when we spun it out is we distributed the shares that CUR got of ValueR directly to CUR shareholders. So every person that owned shares of CUR got direct exposure to Labrador. And so we don't own a stake in it, but we're very, keen followers of it. Again, I'm on the board of the company, and I think it's got a tremendous future in front of us. It's exploration, of course. It's high risk, but it's high reward. No, especially in that belt of rocks.
No, for sure. I actually was lucky enough to bump into Stephen Keith up at the Quebec conference about a month ago. Got a chance to interview him and also do a session with him on stage. So looks exciting. I think it looks exciting. Good team, I say. A lot of money. They've got optionality about how they move that thing forward for sure. So given us, I would say, in terms of, if I was ranking these things, US. Labrador Uranium, what would you put next on the list? Given the kind of early exploration nature of a lot of the kind of the other Canadian projects that you've got in the portfolio, and obviously we've kind of hit upon Argentina and Australia, which perhaps a little bit further down the line. Where would you point us to if we're looking at this?
I mean, look, our project in Quebec, Matouche, is a potential world-class asset. It's the indicated grade of that deposit is 1%. It was one of the most coveted assets in the last sector. They spent $100 million on it. It had a $400 million market cap at the time. We bought it out of bankruptcy for $10 million. And we got it for that price for a reason. Quebec is not the most pro-uranium mining jurisdiction in the world. But if we can make some inroads, particularly with the local First Nations community there's tremendous value in that asset. But that's a longer term play. I think where we see the next development asset, it's in Australia or it's in Argentina, or potentially something else in the US that's not in the portfolio yet. But that's how I would rank the portfolio. But I wouldn't count out Matoush at this point. Matoush could carry our entire market cap on its own if we can make some inroads there.
Right, but this is what I'm trying to work out. I'm trying to work out how to value this thing. I kind of expected you to say the third thing would be M&A, because given my first question to you, which was the markets right now, equities are being pounded, cash-constrained companies, tired CEOs, perhaps not quite sure of how to manage the market. You guys have been able to raise funds reasonably easily, and time it well as well. So Isn't that a kind of big or third leg to the stool for you at the moment? And what are you doing about it?
Yeah, 100%. And a bit harder to characterize, before we've actually announced anything. But I can tell you again that our pipeline's very full. Conversations are being had that maybe we weren't having 3 to 4 months ago, where those tired CEOs of various companies were feeling a lot better about their lives and their ability to raise capital for their own businesses. Those conversations have reignited. And I think that, again, use history as a guide in terms of our company and how busy we've been on the M&A front. We haven't done something in a little while. I can assure you that there are more things happening in this business. And but it's hard to say much more than that in this moment. Okay.
Well, Bill, I appreciate the catch up, and it has been a while. I hope we see you a bit more regularly than this, because I think the portfolio shape has changed and the dynamic has changed to the story, and the focus on being producer developer for me is a big plus on how you've evolved the strategy. So I appreciate your time today. Thank you.
Yeah, thanks so much. Great talking.